growth of insurance companies, but rather it was intended to support the sustainable growth. We must provide strong capital buffers and sound prudential practices which inspire confidence among the policyholders, the investors, and the development partners. Ultimately, this position should ensure that the insurance industry plays a meaningful role in the national development. Distinguished participants, we recognize that the regulatory reforms of this nature require indeed clarity, dialogue, and adequate transitional planning. That is precisely why we are here today. And this sensitization meeting provides you an opportunity and also an opportunity to the authority to explain the extent, scope, and the practical implications of these regulations, while also listening the feedback from you who are the implementers of these regulations. Let us all give our best today to discuss and understand exactly the implications of these regulations. May I take the opportunity to reassure you that the Insurance Regulatory Authority of Uganda remains committed to a consultative and collaborative regulatory approach where we value the stakeholders, and their input is important as we come up with a regulatory regime to govern you. We continue to provide guidance where necessary, which is intended to facilitate compliance without compromising the prudential objectives of the framework. As we deliberate today, I encourage all participants to engage openly, ask questions, and share insights from your perspectives, but also hear from the technical side, which should provide you why we have these regulations and how we intend to implement it. Our collective objective is to ensure that as these regulations are fully operationalized, the industry is well equipped, well prepared, and well capitalized, and indeed well governed. Before I end my remarks, allow me quote the words of Mark Carney, who was a former governor, the Bank of England. He said, open of quotes, regulation exists not to eliminate risks, but to ensure that the risk is understood, managed, and borne by those best able to absorb it. End of quote. Using the words of the former governor, we must therefore ensure that we are the best able to absorb the risks we underwrite. If you are not, then it means you are not in position to underwrite the risk. Ladies and gentlemen, may I take this opportunity to open this stakeholder engagement and also to wish you the very best during your interaction today. Thank you very much for listening to me.
Thank you very much, CEO, for the very insightful opening remarks and for highlighting the importance of today's discussion. And just an update, CEO, we have an online presence, and we are honored to have Mr. John Chisache, the CEO of UIA, online. We recognize you, sir. And just the CEO has set the pace, so allow me to invite the manager risk and actuarial of our IRA to go into the technical discussion about the capital adequacy and prudential regulations. Mr. Musa Sebofo.
Okay, thank you. So to dive deep into the discussion, of course, we all know before I begin my presentation is that the reporting standard does not change the risk exposure of the entities. And we have engaged with some of you on that. So, and the capital is required by the regulator is to be able to absorb the risks or the shocks that happen. And therefore, the rest of my presentation is not actually changing the way we see the risk exposure that you have, but rather because you are reporting differently, how do we measure the capital that you need to set aside with a different reporting standard? And indeed, as you are going to see, the companies that were writing profitable business, this transition is going to have almost little impact. But those that were writing loss-making business, those are the ones that the standard is affecting, and therefore, those are the ones that are affected by capital. Okay. So the issuing of this regulation is in line with the mandate of the authority. Of course, the authority has the mandate to issue regulations as and when it is required. So the applicability, all the entities that are required to have capital measured under this risk-based approach are in scope. That includes all insurers. When we say insurers, we mean insurers and reinsurers, and then the HMOs. So how did we move to this transition? Before 2020, because the regulation that we are replacing is the one that was issued in 2020. But before 2020, we had a regulation that was applying. But I will just mention, because if you have been here for long, you are familiar with it. It was not a risk-based approach. But in 2020, the Insurance Capital Adequacy and Prudential regulations introduced the risk-based approach to capital. And that's what we have been applying to date until when the new regulation came. So that capital approach was based on IFRS 4 balance sheet. So the same balance sheet that you are publishing is the same balance sheet that you are supplying to the IRA, and it's the same balance sheet that the capital model by the authority was using. But when we transited to IFRS 17, of course, they have mentioned a number of discussions were made. But specifically in May 21, there were interim guidelines issued, the IFRS 17 implementation guidelines. They were issued, and those worked until in July 2024, there was a directive issued on some financial components of the capital measurements. One of them was receivables, because we had observed that at transition, all players, almost all, reported nil on the receivables. And we are going to see that receivables is what we use to measure the credit exposure you have, one of the components. So whereas the standard has a different treatment of receivables, the regulatory balance sheet requires that the receivables are then, after your adjustments, they are then brought up so that we can measure the credit risk exposure of the entities. And of all the discussions, issues, directives, and guidelines were embedded into the capital adequacy and prudential requirements of 2025, which the changes we are here to present. So, why were the amendments made to the capital adequacy? I've mentioned one, that the regulatory balance sheet was originally based on IFRS 4. So when you transit to IFRS 17, we also moved with the movement in the accounting standard. And so the regulatory balance sheet with this new standard is going to be aligned to IFRS 17. For your information, I've interacted with some of the regulators in other jurisdictions. And we have noted that there are some countries in Africa where you are supposed to report dual. You have IFRS 4 set and IFRS 17. IFRS 4 is for capital measurement, then we have IFRS 17 for publication. The second one is for those who are from life companies, there were introduction of new terminologies, as we are going to see. The CSM, how you measure the portfolio, and that's one other thing. The third one is the interest rate risk capital. Of course, previously, the regulation was not detailed enough, and so there were variations in the approach to that. We are going to see the expectation of the authority in terms of that capital component in the market risk capital. The operational risk capital, there was an update on that. There is an introduction of the requirement to sign off. It was initially in the directive of July 2024, but now it is within the regulation, as we are going to see. And of course, as we make all those changes and issue new regulation, we then revoke the previous one. So, what are those changes? We are going to dive deep into the changes that have happened. Two definitions, only two definitions that someone is... IT. Next, please. So there are two definitions that we have introduced. The appointed actuary definition is mentioned within these regulations, but was not defined, but it is in the Act, of course, so we just introduced what is in the Act into these regulations. The capital charge definition was missing, and yet it was used and applied, and so it is defined here. Of course, as you are aware, it is the same as what we have been practicing. It's a percentage applied to the different component of capital. Then we have policy liabilities. We were talking about technical provisions. We have made it wider in the regulations. We now talk about all liabilities relating to the policies that you have issued. And the definition is there. Next, please. So let's dive into where the changes have happened compared to our previous regulation. The insurance risk capital. Of course, to recap, we have four components of capital that we mainly focus on to measure. We have the insurance risk capital, the market risk capital, the operational risk capital, and the credit risk. Those are the capital components that make up the capital requirement that the authority has. So the first one is the insurance risk capital that we look at. Of course, for non-life insurers, these are the changes that we have made. So this component has been amended to read that the insurance capital requirement for non-life insurers, non-life reinsurers, and HMO shall be the sum of the risk capital required for an expired coverage, the risk capital required for incurred claims, and where we add the catastrophic risk capital. Now, if you are familiar with the previous regulation, those components were there. But in terms of defining them, the unexpired coverage, we are looking at the liability for remaining coverage. You have issued a policy, but there is a duration that you are going to cover. So you need capital to be able to cover the remaining duration for that policy. And that's what capital we require there. The methodology for it is the one that you are using under IFRS 17. But because the capital charges were explicitly configured to work on the UPR, there could be other components that are introduced in liability for remaining coverage, but the configuration will still apply to the UPR for the remaining coverage. Then we have incurred claims. This is similar again for those who are non-life and group business, short-term business. These terminologies are a bit familiar. We shall continue to look at the IBNR under the liability for incurred claims, and we shall continue to apply the same charges to the OCR that you usually include in the liability for incurred claims. Then the catastrophic risk methodology has remained the same, and the charges have remained the same. Then that is for short-term business. We have said non-life insurers, non-life reinsurers, and HMOs, but you are going to see that for short-term business for life, the same applies. The second one is for the life insurers and life reinsurers. When we reach Schedule 4 and 5, we are going to see the detail because we now spelled more. For those who are familiar again with the previous regulation, there was a full schedule explaining the methodologies and the formulas included in the regulation for the life business and life reinsurers. You will see that in the revised regulation, we have backed off adding a lot of formulas there and rather guided on how that should be determined. We have market risk capital. Market risk capital, like I mentioned, there is an amendment to how we calculate the interest rate risk. And this is informed by the previous practice. Rarely insurers would calculate this component of the interest risk capital. Consistently, we issued letters, reminding you to include the interest rate risk calculation. We noticed that the regulation was not so detailed, and so we have decided to include the detail on how the interest rate risk capital or the components that feed into that capital should be calculated. The other one is, we are going to look at Schedule 8 in the subsequent slides. The other one is the operational risk capital. Now, as you are aware, the formula, the regulatory formula or approach to measuring the capital required for operational risk is a proxy to other risk components. Because as you are aware, if we are to bring a complex method for measuring operational risk capital requirement, it would be hard even for players to implement. So the formula remained the same. It's a proxy to use of other risk components. And when we issued the guideline on this, when we issued a circular on this, there are some questions that came before we even embedded it in this regulation. But I need to answer those questions that came, that the current regulation under operational risk looks at the scale of business. The previous regulation was talking about the operational risk capital of an insurer shall be computed as a minimum of any of the following. And the following are the ones that are already in the current regulations. That's why I didn't include them here. It includes the premium you have written, the technical provisions, but it was saying the minimum. So it was just capping. And this regulation is revised. And with the approach to making it a maximum, it means that if you are a big company, your operational risk is going to be higher than a small company. With the previous regulation, once you reached a ceiling, maybe 1.8 billion, all of you would stop there. So it would be 1.8 billion operational risk capital or below. With this change, it will be moving beyond the 1.8 that you are seeing. So if you write a lot of business, or if your reserves are big, the expectation is that your operations are complex. And because of the complexity of your operations, then you need more capital. So the regulatory approach is that the bigger the company, the higher the complexity of the operations, and hence the higher the operational risk, the higher the operational risk capital requirement. So that is the change that we have made there. Then in terms of valuation of liabilities, we've been saying valuation of technical provisions. We have just defined now valuation of policy liabilities, which include now technical provisions, but other liabilities per the IFRS 17 standard. And in terms, that's the one. Then the financial condition report has been shifted to Schedule 10. The content of the financial condition report remained the same, but the referencing of the schedule has changed. Next, please. So then there is a requirement to submit in this new regulation periodical statements. Of course, that has been a requirement, but the introduction of a sign-off is what is important here. The Act provides for sign-off on annual financial statements, you are aware, and you have been doing. The actuary has been signing, the auditor has been signing, but the quarterly returns, what we have been using in the interim is a circular. But now there is a requirement to have the quarterly return signed off by the principal officer, the chief finance officer, and the key person in the actuarial function, and the internal auditor. So that is the new thing. Because the first one is already in the Act. It is just cited here, where the principal officer, the external auditor, and the appointed actuary sign off. So make sure that even the returns that are coming in by close of business tomorrow, that sign off is done. Of course, you now take responsibility for the numbers. And you are, previously, the fines have been going to the company where there are issues. But now, on top of the company, since all these officers are licensed by IRA, if there is some form of fraud or related misrepresentation, as the CFO or as an actuary, you are now personally liable on top of the company being liable for the numbers. That's the purpose of the sign-off. So you need to confirm the numbers that are accurate and they represent the true picture of the organization. And of course, I mentioned the revocation of the previous regulations, meaning that from now going forward, or from the time the regulations were issued going forward, you need to apply the new regulations. Next, please. So this is just housekeeping. There are some changes in the titles. Of course, the purpose was for clarity. That's why I don't have a lot of explanations. So Schedule 1, it was for clarity to know that these are capital charges applying to this component, which is liability for remaining coverage. The second one is capital charges that apply to liability for incurred claims. And the third one is the catastrophic risk capital charges. Next, please. So Schedule 4. I'm sure if you have life insurers online or here, this is where the meat is. And if you have not been paying attention, you now need to pay attention. So this citation is similar to what is currently in the regulation. It is just elaborating that the insurance risk is the loss arising from the obligation to pay out benefits and expenses of insurance policies and annuities. And the regulation now goes ahead to list out those risks that we are talking about: the mortality, longevity, morbidity, lapse, and expense risk. Next, please. So the projected cash flow that we are talking about here, we are still on the life insurers and the reinsurers, is the same methodology that you have in IFRS 17. So the required capital is where you need to pay attention now. Because for some good companies, you have been doing this because it is also in the previous regulation. But for some few life companies, they have been submitting blanks here. That's why I need to emphasize. So how do you determine with the new regulation the required capital? That is the insurance risk capital for life insurers. We had best estimate liability. I'm now talking about the individual, long-term business. We had the best estimate component. We had the risk adjustment component. And we have the CSM. That's liability for the long-term life business. In the previous regulation, we had best estimate liability plus risk margin, where the margins were prescribed in the regulation. We have removed the margins in the regulation. Now, from the time the regulation is issued, going forward, you will determine the best estimate liability, but the risk margin is no longer prescriptive. The regulation does not prescribe. Because if we had prescribed, we would have moved away from IFRS 17 standard. So to be in line with the IFRS 17 standard, the standard talks about risk adjustment, where those margins in risk adjustment, the risk adjustment ratios, are determined by the entity. And the formula for using risk adjustment is VAR, is what was directed by the authority. So instead of giving the margins, we prescribed the formula for the margins. You use VAR at 75%. So the resultant margin are then the ones that are used. You can ask the rationale for the change. Of course, you know the rationale. You probably know the rationale in the standard. But for us, the authority, the rationale is, it is not only to have a uniform approach, but when we prescribe the margins, they are standard for all companies, irrespective of their risk exposure. When we leave you to determine your risk adjustment, the risk adjustment will vary depending on the exposure of the entity. The high-risk company will have a higher risk margin, and therefore the liability will go up. The capital requirements will go up. A well-managed company with low risk exposure will have a low capital requirement. And I think that's the beauty with the standard, that you no longer have a regulator prescribing a margin for everyone, but you determine your risk levels. So how do we determine capital then? So the first approach, capital component, is the stressed capital. And the question would be, how do we then stress the capital? You'll first stress The regulation says best estimate liability. The best estimate is what you have defined. Because you already know how to determine the best estimate. But we now require that you apply stresses, and the stress factors are stipulated in the schedule that is in the regulation. So you'll have stressed best estimate. That is step one. You have best estimate, then you apply the stresses in the regulation, you stress the best estimate. Step two, you'll have the best estimate, and of course, let me start with the risk adjustment. You'll stress the risk adjustment. And so the regulation is saying the stressed best estimate, you add the, okay, let me go step by step. You get the stressed best estimate, you apply, you minus the best estimate which is not stressed. And the templates are working like that, and the system is working like that. Then you get the stressed risk adjustment, of course, with the stressed bill. You minus the unstressed bill and risk adjustment. Okay? Then you combine the differences. That's a capital requirement under stress. I'm sure I'm confused those who are not in life because they are not stressing. But those who are in life, we are together. So the formula has remained the same. And each stress should be applied separately and the results are aggregated. We have variation of applying stresses in the industry. But this is in the regulation for emphasis purposes. You know those risk factors. You don't combine and apply them at a go. You need to stress one. That's what they are saying separately. You stress one by one. And then you aggregate the results. Some of you have been using maximum. We have been seeing the templates. You pick only the maximum. Yet it says aggregate the results. Next, please. So this is just defining what you should do. You should stress. The discount rate, again, these additional points in the regulations are for emphasis. That the discount rate you use should be the ones that you use in the balance sheet. You cannot have a different liability you are stressing and a different one from the balance sheet. It is just emphasizing that the balance sheet liability should be the one you apply when you apply stresses. Again, to bring it out clearly, we are using the government of Uganda yield curve. And of course, you know the reason. The liabilities are valued using the government of Uganda yield curve because it is market consistent. It gives you the day-to-day value, the current value of the liabilities. Correspondingly, which is in line with the IFRS 17, the assets are also valued on market basis. So what we are doing is that when assets are valued on a market basis, the liabilities should also be valued on a market consistent basis. But because we don't trade liabilities, it is hard to sell a liability because there is no secondary market for liabilities. So for us to be able to determine the market consistent liabilities, that's why we require to use government of Uganda yield curve. I'm laboring much to explain the rationale behind all of these changes, but I believe those who have been doing the right thing might be aware of this. So that is one capital component, the capital resulting from stressing your liabilities. There's another capital component that is results from applying the capital charges, which is the factor-based capital, using factors applied to the liabilities. So this is the second capital component. Apply capital charges or factors to the liabilities. And when we say liabilities for life insurance, we are still on life insurance, we mean the three components, all the components of liabilities. The bill, the risk adjustment, and the CSM. So that is for individual life, you get the maximum of the two. Either the stressed capital or the factor-based capital. You pick only one. Once you get the maximum, then you add 3 if you have group business. You add for group business, group credit, and etc. Next, please. Then you add catastrophic capital. So those are the components for a typical life company of capital, insurance risk capital. You have catastrophic, you have capital for group business or short-term business, you have capital for long-term business. So when you add the 3, then you arrive at the capital, insurance capital requirement for a life business. Next, please. Then we talked about the change, the detail that is provided in the interest rate risk capital. This is not new. It is what we issued in the circular of July 2024, but now embedded in the regulation. And the reason is, I need to mention this, that non-life companies do not stress their assets, they don't want to stress their liabilities, and yet they have classes of business that run for more than even a year. Engineering, whatever. Because your liabilities run for more than a year, we expect that you have investments that match the liabilities under the asset liability matching. And so, the explanation when we issue that comment is, these are short-term, they are less sensitive interest rate. Okay, demonstrate that they are less sensitive. At least you do the interest rate stresses and demonstrate to the authority that there is nil impact, rather than leaving a blank or putting zeros everywhere. So we'll be very keen on the subsequent returns, especially on the interest rate risk capital. The stress is similar to the previous regulation. I don't want to labor much, but I want to go down to the next one, where we tried to list out examples of assets that are interest sensitive. Next, please. Okay, the determination is what I don't want to go through, because this is similar to the template you have, and it's similar to the previous practice. It is not new. But what is new, next please, is the listing of examples of interest rate sensitive assets. That once you have them, then you have to stress them. Okay? And of course, CFOs who are online and here, you are very familiar with this aspect. Next, please. Again, this is just similar to what we issued in the circular. Next, please. Then in terms of liabilities, again, this is for emphasis purposes. We have the insurance contract liabilities for the incurred claims, insurance contract liabilities for the remaining coverage, and the insurance contract liabilities held when you are stressing the liabilities. Next, please. Okay. The Schedule 10 and 11 in the previous regulation were removed. Those schedules were bringing formulas which apply to IFRS 4. That's why we removed them. I'll give you an example that is there. It is where we prescribe the gross premium valuation methodology, which no longer applies. So those were removed. And Schedule 12, which is the financial condition report, was changed to Schedule 10. Maybe to note on the financial condition report, one thing that is in the regulation that some players have not been following, and of course comments have been coming through quite often, is the projection of the capital requirements for the next 3 years. It is actually not new, but I'm just bringing it out for emphasis because the practice is different. what has been done previously, even up to last financial year, is you present historical numbers, 2023, 2024, 2025, but the regulation is clear. You project for the next 3 years. And so you need to project. The regulator wants to be proactive. They also want you to be proactive. If you anticipate insolvency in the next year, then you put actions in place to avoid insolvency. And that's why you require that you project your solvency. That is in the financial condition report, which is now Schedule 10. The other one is asset liability matching. That has also been missing. Those who try to bring the asset liability matching, which is also in Regulation 10 now, they bring the block of assets and the block of liabilities, and they say we have a surplus. But the regulation is clear. You are going to read it if you have it there. It says asset liability matching by duration, by nature, by currency. So if you are selling dollar policies, we need to see the assets that are in dollar that are matching the liabilities in dollar. If you are selling long-term business, we need to see a spread of assets that are matching the spread of the policies that are long-term, which is not presented. And so we don't get a picture of your exposure in terms of risk. We mentioned that we are risk-based now, and the capital is risk-based. So this time round, we might apply some clauses in the Act that might require you to present the way it is supposed to be presented. Because you are risk carriers. You need to be more proactive than a non-risk carrying entity. Your business is to insure risks. And so the authority needs to be aware of what nature of risks that you have carried and the nature of assets that are backing the liabilities. And so that has to come out clearly in the financial condition report, which is in the schedule now 10. Next, please. So the other directives which you need to comply with is the circular of the one I've been referring to, of that reference number, the aspect that I want there. I think 3 aspects that I'll pick from there, but again for emphasis purposes, because those are the gaps that we have seen in the past. One is the CSM. The CSM, for those who are non-life, CSM is just the profit value of the business as written. We call it CSM. You have written 1,000 policies. What is the value of profits for those policies? Now, on one side, the standard specifically says that's a liability. And you all agree with me. The value of profits is a liability. When does it cease to be a liability? Is when you provide cover for the policies and you remove that liability, it goes into your P&L as a profit. But before you cover for the period, the authority also recognizes it as a liability. But, of course, there was argument that we then apply capital charges on the value of future profits. And some companies were complaining. But these are profits. Why are you applying capital charges to it? And I will give a reason why we then recognize 20% of it. So on one side, we apply full capital charges. On the capital available side, then we credit 20% of the CSM, not 100%. Reasons are, one, you are the ones who determine that value. We don't prescribe how you determine it. So your methodology could be having some limitations, either intentionally included or unintentionally. That's one. And the authority cannot take that risk in terms of protecting policyholders. So that's one. But two, that value is just assumed value. You make assumptions. The reality has not come. And you realize that the value of CSM is highly volatile, those who are in life insurance. So we cannot use a volatile number to make a regulation. That's the second reason. But why we then credit it, it's because worst case scenario, should the company discontinue, then it is probably not zero. That value is not zero. And we looked at the lower side, the 20 percentile, the 20%. So 20% of which is now. But we recognize the closing CSM. Because you know the opening CSM will be interrupted by many things. So the 20% is the closing CSM. So in your templates, make sure in the system, you have to make sure that your closing CSM is the right number, because it is where the 20% applies. I've mentioned about the yield curve. I don't need to mention it again. The third component, which I didn't include there, is the receivables. But I mentioned it at the start. I'm just bringing it again for emphasis. The standard does not include receivables on the face of the balance sheet. The regulatory balance sheet is similar to IFRS 17 standard. The only difference is the face of the regulatory balance sheet needs to present receivables for it to be able to measure your credit risk exposure. And so, as you engage your auditors and actuaries, it should be easy for a regulator to remove the component of the receivables and go back to IFRS 17 balance sheet. You introduce receivables, then you go to the regulatory balance sheet. The other components should not be affected. Now, what is the impact of the changes that we have made? We said that the regulation came in 2000, and you can see that the trend is some companies were almost at par at 200%, slightly below initially for non-life and slightly above. When the new standard came, there is a jump in 2024. You can see the curve going up. That jump is because people enjoyed that period. They removed the receivables, which are in the regulations. They brought 100% of CSM, and all issues happened during that time, before we issued a circular. So that's why you see a peak around the June 2024. So don't celebrate that the capital for the industry went beyond the normal. It is because of the CFOs decided to apply their accounting principles. But when we issued a circular in July, after June, then that's why you see subsequently the capital values settled. And as we talk, the life company is lying between around 270. That's the average we have seen consistently. Life companies' capital, all of them aggregated. And this is weighted capital adequacy ratio. So we don't just aggregate the ratios. We calculate the industrial capital available and capital required. So life companies are around 270. So if you are below, you need to work hard. The non-life companies, as a result of these changes, is around 240. You can see that the blue is the life. It drops a bit because you are all aware that there was suspension of one of the companies. So that's the one that caused that. But the other thing is that there are some few companies that carry out dividends. So when it goes far above, then shareholders share their surpluses. And so it is not, apart from that company, it's not a negative thing. So we are around 270 and 240 for non-life. Next, please. So what are the next steps and responsibilities for each of us? For us, we have implemented the changes in the system. We have issued the guidelines on how to use the system. And so the capital, all these calculations are now in the system, the RBS software. Your role is not to calculate capital. Your role is to upload data as required in the guidelines and in the template. And then we'll continue monitoring, first, the quality of data submitted, but two, your risk exposures now. Then your role is, I have mentioned, is to align with the new regulations. Next. Okay, that's the end. Thank you. I can now hand over to the moderator.
Thank you so much, Manager Risk, for that incredible presentation and taking us through the technical aspect of the capital adequacy regulations. For the non-finance people, how are we doing? I was puzzled about the stress testing, the ALM, but I think we've all grasped the amendments and the technical bit of these regulations. And I think we now have a proper picture of what is required. So I'll delve into the plenary Q&A, and Musa will be taking the questions. Just a reminder, let us stick to the amendments. Let the questions be in line with the amendments and the presentation that Mr. Musa has made. So I'll ask Fatuma to help me pass the mic around for anyone with questions. Please feel free to raise your hand. The microphone is going to be moving around. Anyone with questions? Okay, there is a question here. Before you ask the question, just a reminder to the online participants, you can type your questions in the chat and we shall surely read them out. I'm seeing a question from Dennis. He did not address non-life. Can we have a session for that as well? We shall respond to that. Please.
Thank you, Mr. Sebufu. Mine is on the insurance risk capital calculation. In the 2023 return, we realized that the return was peaking the net written premiums instead of net earned premiums, whereby it was subtracting the gross written premiums from the net written premiums to come to the calculation of net earned premiums. When we came to 2024 return, where the formulas were hidden, the calculation for net earned premium was not reflective of the picture, the numbers we have. So I would request if that change is made, to have the charge on the actual net earned premiums of the company under the catastrophic risk charge under insurance risk. Thank you so much.
Okay, thank you. Any other questions, so that we take like 3 at a go and he responds, then we shall take the rest.
Okay, we have a question online from Dennis. He's asking, the presentation didn't address non-life. Can we have a session for that as well?
Yes, we have captured that. There was a question on the other table.
Thank you very much, Musa. And I know we've discussed extensively on some of the things. And for life business, I think what I see is more or less we've now just put into the regulations what you had already guided on. Now, I was hoping to get some good news on CSM, maybe that you're raising it to 40%, but I see you've still maintained it at 20%, which is the bare minimum. So I'm hoping that before we finalize, at least you have a relook at that. If not, then just have to abide. The others are really just comments. So when we moved from IFRS 4 to IFRS 17, the comparability of financial statements now became a bit of an issue, especially when we are looking at things that like insurance revenue, especially that. So I don't know to what extent, as the regulator, you can then be able to not to influence the adoption of the standard, but just to review further the methodologies, especially on the endowment side, the evaluation of the endowments. And ultimately, we know that also impacts part of this that we are discussing on capital adequacy, just to streamline the presentation and how that valuation is done. The last thing from my side is I'm happy that you have clarified on the technical provisions for a life business. Currently, through UIA, we are in engagements with URA and the ministry on streamlining taxation of life business. And one of the things we really wish to rely on is the specific clarity around the technical provisions of the life business. Because URA is asking about that. They are very clear on the non-life because it is straightforward. They are not very clear on the life in as much as we explain that. So let it just come out clearly the way you have actually explained it, clearly listed. They might not be exhaustive, but at least they will provide guiding principles to other regulators that we deal with. My last comment would be, now that we are in audit periods, I think it would also just be good for future if we get maybe a representative from each of the key audit firms that are licensed by RA. When we introduced the premium, the premium data on the endowment side last year, explaining between the regulatory balance sheet and then what you actually, they're actually auditing. Also, we had a bit of back and forth. So yeah, sometimes it's just good to align at once, but I'm sure for those that are adopted last year, then it should be an easier thing to proceed with. Thanks.
Let me first address this. Someone said I didn't address non-life. Probably joined when I was on the life slides because the life slides were a bit longer. But I can make one statement to help that person, is that we'll apply the capital charges the way they have been to the UPR, IBNR, and the OCR. We just changed the nomenclature to align with IFRS 17, the liability for unexpired risk, and the liability for incurred claims, and the catastrophic risk. There is no stressing in non-life currently, so it is as simple as that. I'm sure the CFOs for non-life are enjoying the standard. Then the net earned premium, yes, I think one player had raised it. Those were 2023. And what is in the system now is well aligned to the net earned premium. So the charges apply appropriately currently. And I think when you upload the data and subsequently get to see your capital adequacy calculation, you'll see that it is aligned to your expectations. CFO of Old Mutual Life mentioned about raising CSM. I think he also got my answers before he asked, because we have engaged extensively offline, and the reasons that I have presented are the reasons why we keep it at 20%, where in Kenya it is 0, Tanzania it is 0, Rwanda it is 0, and we got a question from Zambia. They wanted to learn from us. So you seem to be enjoying more than the others. You are ahead of the market. The comparability of financial statements, I think, like you said, we engaged. And for the companies here, you will notice that every time we now come for inspection, part of what we ask is the methodology document for liability evaluation. So we look at also the experience investigation and the assumption paper. Those are the things that significantly affect the numbers that we see in the insurance revenue. So I'm sure you have also experienced those requests from us. We now ask for, where is your methodology document? For us to get comfort in the numbers that you are presenting, we need to be comfortable with the methodology. And especially for endowments, like you have said. The tax implications, yes, I think we need to, we have engaged with you and the other stakeholders on the interpretation of the life business, and I think we will continue to make that explanation of technical provisions to the authority and other stakeholders. The representation from auditors, I think this is noted, and going forward, I think we should be able to have them either on call or physically here, so that the players are aligned with the auditors when it comes to the auditing process. Moderator.
I hope the questions and issues have been answered. Do we have any more questions or concerns? There is one online. I would like you to put more light on scenario where the LRC for a given quarter becomes negative. What the financial signals? What are the financial signals? Can I repeat? John Bosco Waswa is asking, he's requesting for clarity on scenarios where the LRC for a given quarter becomes negative. What are the financial signals? Do we have any other questions in the room? Okay. You can respond to that.
The beauty is I have CFOs in the room, because my expectation of the liability is positive, especially for the remaining coverage. Is it a case where you are releasing more than creation? I don't know. Tony, you have a comment on that? It is a unique scenario. It's something to do with the wrong application of methodology, in my opinion. I would expect it. The period is still there. Unless you over-reserved at the start and you are now releasing more than, the period is remaining. The liability has to be there, and it is positive. And a scenario is that number will always be positive. And so I think I have answered that one. Okay. Property risk charge. There is a property risk charge that the RBS template applies on hypothetical right of use assets. I would expect that the charge would be amended to only with actual property investment. But actually, the number 2 is already in the regulation, and it is not even in the new regulation. It's in the current regulation. And it is okay, right of use, the charge would be different from if you actually own the investments. So I think we'll note maybe future changes in the regulation. We can discuss at length that. But there are no changes on that aspect. The interest rate risk, the authority's view, or stressing assets with fixed interest, the view is that all interest rate sensitive assets should be stressed, whether they have fixed interest rate or otherwise. As long as it is interest rate sensitive, then you have to stress. The regulatory capital requirement is not for a business as usual. It looks at the worst case scenarios, okay? The fixed interest works in a going concern basis. But under stress scenario, you may not realize that fixed interest. So that's why we are saying stress, worst case scenario, you are being discontinued. You have to liquidate the assets by force. We realize the agreed fixed before the duration has expired. So that's why we say all interest rate sensitive assets must be stressed. Moderator?
Thank you, Mr. Sebufu. Well, not all of us might have questions, but we would like to hear from the insurers your experiences, your challenges, the positives, because the regulation, despite the regulation having amendments, this IFRS 17 and the requirements were rolled out earlier. So we can hear from you. Give us your experience, any challenges, or even the positives that have come with the changes that have been made in the financial reporting. John Bosco Waswa is still asking, doesn't this attribution of expenses overestimate the profit after tax?
Okay. The expectation is that the expense attribution is done using a methodology which is in IFRS 17. And so if you have followed the IFRS 17 standard in terms of expense attribution, then the results you get is what it is. If the profits are high, then they are high. But the scenarios where you see abnormal profits is when you have not applied the methodology appropriately. And so you are addressing sometimes data issues or application issues. The methodology is okay. And we expect once you have applied IFRS 17 methodology for expense attribution, the results should be okay and comfortable. But as a regulator, we also rely on the external auditors because they now look in detail your methodologies and its application. So if you are using an external auditor, especially on the annual financials, then they should be able to touch into how you are applying the methodology.
Okay, thank you. I'm calling upon any more comments, the experience when it comes to implementing the new financial reporting standards, challenges. Those online and the people in the room, feel free to raise your hand and let us know. Okay, in case there is none, I would like to thank. Okay.
Thank you. Thank you, Musa. I think on the reinsurance default risk, you give us the ratings of different insurers and the capital charge that will come with that, but you do not give us the rating agency because they are different rating agencies. Should we assume that if the reinsurer is rated by S&P or M-Best as A, the rate is the same or that is different? Because the different rating agency gives different rates. And when you try to research on that, you find that if someone is S&P, there is a conversion. If he's A, then you'll find him is A+ for M-Best and other entities. And the other one is on the receivables. I see in the regulations, if it is above 30 days, then you charge 100%. But as insurers, and I think we've held several discussions with UIA, we were requesting to have it banned, not in the two bands that are available, that if it is 0 to 30, you charge 0, then the rest above 30, you charge 100%, because there are different scenarios in the market that we have, especially with the government, where they are unable to pay within even 90 days. I can give you a live example with the amalgamation of government agencies, we are taking a full 365 days to collect on the date, and this is government debt. And if we are going to charge 100%, I think it is very costly on the side of the insurer. Thank you.
Okay, there's another question online by John Bosco Waswa. He says, I would like Mr. Sebufo to clarify on the non-attributable expenses. Which financial position should they be recorded? There's another question. Okay.
He asked one of the questions I wanted to ask. Then the other question was, will we be able to have access to your presentation, especially that we have 1 day to submission of the return, to guide us more on application of the new regulations?
Actually, I should start with the last one. Access to the regulation, actually. This is just some pieces from the regulation. A full regulation is at the IRA website. And you are free to print, download, and anything. The reinsurance default risk, rating agencies, all credible. We could not list the rating agencies because tomorrow one can come up. It would be very prescriptive to add the rating agencies list in the regulation. So we consider all internationally recognized rating agencies. The second point on that is that in case you are assessed under the 2, and one gives B plus, another one A, the prudent approach of the CFO is to take a B plus. Because you are sure that tomorrow, if the one rated A now downgrades to B, you are still solid enough. So you use the principle of prudence. You take the worst case. Receivables under 30 days, you are aware of the requirements of cash and carry, both in the Act and the directives that were issued, that you don't provide cover before you have received premium. Actually, the capital requirements regulations have to align with the Act and other directives which expect cash and carry. The 30 days provided for zero capital charge because we know expectations of the operations of the insurance. Today I do a transfer, then it takes some days before you credit my policy. So the 30 days otherwise would have started at 0. But it is cognizant of the actual operation that direct debits and other forms of payments can take some delays before they reflect on policyholders' accounts, and we don't want to disadvantage the policyholders. So therefore, above 30 days is 100%. But maybe you should look at, the question should have been, why do you ask capital? We ask capital because you are carrying a risk which is even greater than the premium that you are receiving. If you are receiving 1 million, you are probably covering 500 million. And so, if the person you are covering has not provided a premium, the rationale behind this capital is you, the insurance company, you pay the premium. When they pay, you refund yourself. And hence they say, go to your capital, remove that amount, then pay on behalf of the client. That is the logic behind the law. When the client pays, you have, because premium is based on some assumptions, calculation, probability, what? So that when the risk happens, the regulator wants you to be able to pay the promises you have made. Now, if you give a wrong impression that you are covering an entity, then the claim comes, then you say, but you didn't pay. you are causing a disruption in the industry. You are giving a false hope that someone is covered when is not covered. So that's why we require you, even when the claim comes, you pay because you covered and deduct off the outstanding. Okay, I think I have exhaustively answered the question. The one was on, there's one I saw on financial treatment of numbers. I think JB, this is more of applying the standard than the capital requirement discussions we are in. You can have further discussions with the other finance professionals on how you apply the standard in the reporting.
Thank you, Musa. Just before we close the Q&A, just to clarify whether anyone has any additions, experience, challenges, and any positive attributes that come with the IFRS 17. Okay, I'm seeing a hand up. 2.
Mine is really to help my brother, John Bosco, so that he goes there with an answer, if that's okay, Musa. So on application, on the expense side, you need to start from where you are. So are they attributable to your product or are they non-attributable? On the attributable ones, then you go through a whole process of how you're going to attribute them, including cost allocation methodologies. Then on whatever is remaining, that one you also have to book it in your statement of profit or loss and clearly indicate that portion, you incur it as an expense, but it cannot be attributed to your products. Thank you.
Thank you. He had a hand up.
Thank you. Probably this is not related to the meeting, but we just need to get clarity. The RBS system that was sent to us totally failed to work. We sent emails, and the team is saying that they will get back to us when the system is restored. So how do we proceed? Because again, you are still sending circulars saying that we should use the system, well knowing that the system is down. How do we proceed?
So the system is on. You can log in there. It has been on from last evening. There was a temporary interruption yesterday, as any other system. It was not actually the system, but the infrastructure that supports the system. And of course, it's like your phone temporarily freezing. It was just a freeze, and it was quickly restored. If you can access if you have your laptop there, you can click in. You'll see the system is working properly from last evening. So you can. It is still, the circular still stands. We need to upload the information in the system, and capital will be measured from the system. The signing to be done. The signing, we are working on the uploading of the signature, but for now, the sign-off document, which you have, should be sent via WeTransfer, the usual methods. But subsequently, once we finalize the electronic sign-off, we'll communicate the same.
Okay, thank you so much. I think we've come to the end of the Q&A, and I must agree that it has been very engaging and fruitful. At this point, I'm going to invite the Director Legal and Secretary to the Authority, Mrs. Francesca Kakoza, to give us our closing remarks, the key takeaways, and the steps forward. Mrs. Francesca Kakoza.
you very much, Gerin. Okay, it's still morning. Good morning, ladies and gentlemen. Once again, I want to thank you so much for attending this stakeholder engagement. It is important for you to be able to understand the regulations that we issue out, but most importantly, for you to be able to comply. And from what I'm hearing and reading online, it looks like we've all understood. One of my teachers told me that if I don't see any hands, it means people have understood, or they are still reflecting and they'll ask the questions later. So I'm imagining that is the issue here. You have completely understood everything, and I'm glad that we have CFOs and people that work on these documents, returns all the time. And so I'm sure that you've been following what Musa has been explaining, and you will be able to comply. So thank you so much once again, and I would like to thank you, Musa, for throwing a lot of light on the changes in the regulations. I am not mathematical, Gerin, but I was able to follow, and I'm sure we'll be able to also enforce compliance as we move forward. As you know, this journey did not just start today. We started this over 3 years ago, and we've taken you through various training on IFRS 17, as well as in relation to capital adequacy and prudential regulations. So I'm certain that we've had a good journey. And in fact, one time it was pronounced that Uganda is far ahead in terms of implementation of IFRS 17. So I'm sure that where we are right now, from the guidelines, from the engagements that we've done before, we are all on board to comply. And so once again, Musa, thank you for what you've taken us through. I've listened to the key changes. There doesn't seem to be much, especially since we have walked this journey with the industry from the beginning over 3 years ago. But critically, what I've seen is the alignment to IFRS 17, which has finally been done through these regulations 2025. And then, of course, the key definitions and changes to nomenclature that you need to take care of as you comply with the regulations. The other one is the formula prescriptions in relation to margins, the issue on stresses, which has been explained very well, and of course, the way forward, which again, Musa has guided us ably. Now, for the industry and for the CFOs, our ask to you after this very effective stakeholder engagement is for you to review these new regulations. Take note of the changes where they are. We are still here to provide the explanations. We have Musa is available, our supervision department is available, our acting director, supervision, I don't know if he was introduced, but Mr. Kaddu, Stephen is over there, he's acting. Bernard, our substantive director, is also available to give you further explanations. So please feel free to ask beyond the stakeholder engagement so that you get the understanding to apply. So yes, so review the regulations for the compliance champions, compliance officers, ensure that you extract the obligations, especially the new ones, because I'm certain you've already extracted the other ones that were in the older regulations. So for the new regulations, extract these regulations and ensure that your management teams actually understand and are on board with you. So review, extract, engage with IRA for further explanations where you need to, but also with fellow colleagues in the industry. We've seen, yes, the CFO from Old Mutual has explained something to JB. So let's have that engagement, do the consultations in the industry. Where things fail, IRA is still here to explain further. So review, engage, understand, and then finally comply, because there's a non-compliance attracts a price. So ensure that you comply. Other than that, we would like to thank you for coming in big numbers. I've seen we have a huge attendance. At one time, we had 85 people online. I would like to thank you, our online audience. Thank you so much for being attentive. But for those that have attended physically, thank you so much for attending. And please do come whenever we invite you for these stakeholder engagements, because like the CEO said, we want to do proactive regulation. We don't want to walk a mile and leave you behind. We want to work with you so that you're able to comply and so that we're able to grow this industry and ensure that it remains resilient and stable. So thank you so much for attending, and I would like to wish you a very good day and also close off on this note. Garen wants to come back? Okay. Thank you so much, and I would like to close the workshop. Thank you.
From money, shilling, and cents. Economy, centonomy. I think that's what it comes from. The CEO is Waithaka Gatumia and is our guest for the next hour. Waithaka, good morning.
Close enough.
Yeah?
Eric, close enough.
It's not economy of sense.
So, cent, money, autonomy.
Agency.
Sense, autonomy.
Yes.
Kabisa.
Yeah, I can't claim that one for myself. I can't.
So
nothing is free. Nothing is free. It's our founder Washeke who came up with that idea. So yes.
Beautiful.
Yes.
Karibu sana.
Thank you so much. It's a pleasure to be here. Good to see you guys, and you're doing a good job.
Thank you.
I love the new place. It's very good.
Thank you.
Yes.
Yeah, it's what we say is podcast meets broadcast.
Hey.
It's broadcast meets podcast. It could be
either way.
Yeah.
But you're doing a good job.
Asante sana.
Appreciate that.
Jano.
Yes.
The quote.
The quote. Alice Walker, author of The Color Purple, a civil rights activist, an activist in many ways. The most common way people give up their power is by thinking they don't have any.
Yep.
That's the quote for today. The most common way people give up their power is by thinking they don't have any. Wow. Right?
Yeah. No, that's really cool. Because I think in this economy, especially when you're talking to young people, there's a sense of lack of that agency that you are discussing, a lack of power. And I always have this argument when I'm speaking to like university students. They say, there are no jobs. I say, okay, That is not true. I've never woken up on a day and I go to one of these job websites, go to the newspaper and look at and there's 0 job offerings. The issue is that probably you've not aligned to the jobs that are available at this point. And even if there are none that are aligned to you, go and create one. I mean, I've seen that with people who have just said, I really want to work for this organization. They come up with a plan, they go and present that plan. Does it work every single time? No. But can it work? Yes. And so I love that. The idea that if I believe that I have that power, then I have the power. If I don't believe it, I don't have it.
Does the same apply? I mean, I like that you've said that in the sense of you're telling people either you'll find it because there's an array of opportunities or you have it within you. Sometimes the climate, the temperament, people feel like, no, really, the jobs seem fewer. Even if I'm working towards a job, I'm not making enough that I can pursue my dreams. If I want to start a business, there seem to be so many barriers, borrowing capital. So they're just seeing barriers. So one could say it's an excuse, but maybe there's an explanation. What could that be?
You see, the thing is, entrepreneurs, in fact, it's great that you've brought that up. Entrepreneurs start businesses because they want to. They make a decision. You think about it, the M-Pesa shop that just opened down the road, is it because there was a lack of M-Pesa shops? No. It's that this person said, hey, there's an opportunity here. I'm willing to take it. I'm willing to take that risk and discover what is coming out of this place. And the thing is, for many of us, we look exactly as you said at the barriers and not at the opportunities. And so same thing, even with your investment. So, the markets are down, it's hard to get into this place. If that's what you see, then that's what the truth is. But there are others who are saying, you know what, yes, the markets are down. That means that I'm getting a good deal if I'm buying shares on the stock market, for example. So how we view things matters a lot. And we spend a lot of time, for example, in the Centonomy classes, people always wonder, why do you have a class on mindset? Why do you have a class on, and we have life coaches who come and help the people in there? Because sometimes